Universal life, IUL. What is universal life insurance? Universal life insurance is an interesting concept and product. It is the newest type of life insurance and was developed and debuted in 1979. In this video, I will explain as briefly as I can what universal life insurance is, the three forms of universal life takes, and what it means for you as a consumer. Aloha, I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse finance strategy, and I'm the managing director of the Hawaii Financial Freethinkers Academy, a nonprofit financial literacy education organization. If you find this to be helpful, please like this video and subscribe to this channel. Also, please post your questions and comments here. Now, prior to 1979, there were only two kinds of life insurance: whole life and term life. E.F. Hutton developed and introduced flexible premium life insurance, which later became known as universal life insurance. While life insurance is considered a permanent and cash value life insurance, which puts it in the category of whole life, is actually more similar to term life than whole life. Let me back up just a bit here. There are three kinds of or categories of life insurance: whole life, term life, and universal life. Burial or final expense insurance is a subtype of whole life with special restrictions. Universal is kind of like a blend of term and whole life, more like a term policy with a whole life disguise. I'll explain as I go. As I mentioned earlier, universal life started out being called flexible premium life insurance. The idea was that the policy owner could make larger or smaller premium payments within certain limitations. And you could even decrease the death benefit if you wanted to lower the required premium. This new life insurance would also be able to grow cash value similar to whole life, and the cash value could be withdrawn or borrowed against, again, similar to whole life. However, unlike whole life, cash value is not guaranteed, and neither is the death benefit. The way that the premium may be flexible is when cash value has accumulated in the policy, the owner may choose to pay a lesser amount than the scheduled premium, as long as there's enough cash value in the premium in the policy to cover the difference in the premium. And if the owner chooses to, they may overpay the premium up to a certain limit. And then the extra amount will be put into the cash value, where it may receive interest or investment gains. The issuing company has the right to change the amount of interest paid at any time for any reason. Here is where universal life is most like term life. The cost of insurance, or mortality cost, increases every year with the age of the insured person. And that increase is charged to the policy. So while the premium may be advertised as staying constant, that really is only the case if the cash value of the policy grows enough to cover the difference as the cost of insurance continues to increase. There are other fees that the insurance provider charges to the policy, and these can also be raised at the discretion of the provider. Besides the increasing cost of insurance fee, there's also the cost of maintenance fees charged to the policy. And administration fees, maintenance and administration fees. When the premiums paid for the policy do not fully cover all the costs and fees, the provider will take the balance from whatever cash value there is in the policy, and the provider is not required to notify the policy owner. When there is not enough cash value to cover all the costs, the policy will lapse. So while universal life is called permanent insurance, that isn't necessarily the case. Now, there are three versions of universal life: guaranteed or GUL, indexed or IUL, and variable or VUL. GUL purports to have a guaranteed death benefit and a guaranteed cash value and a guaranteed maximum premium, none of which is actually guaranteed, as I just explained. IUL ties the cash value growth to a stock index, such as the S&P 500 or any of the many stock indexes available. With IUL policies, usually there is a guarantee that the policy will never have a negative cash value move due to the stock index. That is, it has what is called a zero floor. Well, what that means is that if the stock index loses money, the worst your policy will perform is a zero gain, but it won't lose money due to the stock index. When the stock index does well, the policy cash value will reflect a gain. Not as much as the index gains, though, because there are caps placed on how much a policy's cash value can grow in a year. And even if the gains aren't up to the cap, there are administration fees, which will reduce the amount paid to the policy. The variable in VUL doesn't refer to the variable premium provision, but rather it refers to the variability of the stock market. VUL policies actually have an investment component where part of the premium is invested in specific stocks. So when those stocks perform well, policy investment account gains up to the cap and minus the administration fees and maintenance fees. Unlike with GUL and IUL, with a VUL, when the stocks it is invested in lose money, so does the VUL policy. As such, VUL policies require that the agent selling them must be licensed to sell investment products. In other words, the risks are placed on the policy owner. IUL and VUL have potential to make good gains if the market performs well, but the death benefit never grows as it does with participating whole life. And as I explained earlier, the cash value and the policy can completely disappear if the market does poorly and as the cost of insurance increases. Not to mention the associated fees that can be increased whenever the provider chooses to increase them. You have questions? We have answers. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. The link is in the description box below. The link to buy my books on Amazon.com is also below. And if you'd like to book a free phone consultation with me, the link to my Calendly page is also below. If you'd like to apply to become a client of ours, the link to the application is also below. We're here to help, and we look forward to helping you. For now, aloha and mahalo for watching.